Nancy Lanard at Lanard and Associates, and today I'm going to talk about before you buy a business. And as the little image shows, you need a lot of things to plan out before you buy a business: a marketing plan, a business plan, um, and how are you going to grow this business and make it successful. Today I'm going to talk about some of the legal aspects when you're acquiring a business, and they also apply to even the sale of a business if you flip some of the points. So the first point is that typically you're going to start negotiating with the seller for some of the key terms of the acquisition. And when you do that, the first document typically that memorializes that is a letter of intent or memorandum of understanding, known as an LOI or MOU. And this should be the skeleton or the framework for the actual purchase agreement. Typically, it's stated as a non-binding document, but be careful because the terms typically are used for the final purchase agreement. So be careful in what you negotiate in that. Some of the key terms are the purchase price. What are you going to be paying for this, for the assets or for the stock of the business? Is this going to be an asset purchase, or is this going to be a stock or membership interest acquisition? What are the terms and conditions of the transaction? Is there a non-compete of the seller that you're going to require that they not be selling the same products or offering the same services or open a similar business or a competing business within a certain time period in a certain area? Is this an as-is deal, or will there be warranties? What are the contingencies? What is this deal contingent upon? And is there a due diligence period, and how long will that be? So let's talk about each of these key terms. Asset versus stock deal. Should you buy the stock of the corporation or the membership interest of a limited liability company? From a seller's perspective, it's great for you to buy their entity because you're taking on all of the liabilities that might be outstanding there that they may not even know about. But from a buyer's perspective, it's pretty rare for me to ever recommend that you purchase the stock or the membership interest of an entity. Acquiring the ownership of the entity bears huge risks. There's unknown liabilities out there that you can never protect yourself fully against. So, for example, if someone were to slip and fall on the premises of the store of the business, and you were to acquire the entity of that business, you can't check for that if they haven't filed a lawsuit yet. So that might go well beyond any insurance that was carried at the time if the person passed away as a result of that slip and fall. So you can't protect for that, and that could really shut down. It could take up all of the financial strength of the business. And so that's just not a liability that's worth acquiring. Buying the assets of the business allows the buyer to choose which assets he or she wants to acquire and thereby also avoid the liabilities of the business. Acquiring the entity of the business, the stock or the membership interest, also means you're acquiring all the employee benefits that the employees have accrued. And you as the new owners are going to be responsible for all of the liabilities of those benefits, accrued vacation, accrued sick leave, and so forth. So generally, it's best to buy the assets of the business and not the ownership of the entity that owns the business. What kinds of due diligence should you be doing? I always recommend at least 3 years review of the business tax returns. That's very important, and you might want to have your accountant review those 3 years of tax returns. Review all the permits and licenses for the business. See what permits and licenses the business has over the period of the ownership of the business, and whether they are compliant with all federal, state, and local laws of the business. Review all contracts and leases for the business so that you know what you're actually acquiring, what your obligations are under those contracts and those leases, and are there equipment leases, and what real estate leases are out there, and are there contracts that are important to the success of the business, and if so, how long are all of those leases and contracts, so that you know when will you need to be up for renewal, that you're going to need to worry about whether these are going to continue or not, and whether the landlord or the other side of the contract holder will be renewing with you, because that also impacts the value of the business. You should also review or have your accountant review the financial statements of the business for the past 5 years, along with any accompanying accountant CPA letter from a reputable accounting firm. You should review all the customer lists, sales records, advertising materials, and costs of running the business, employment and management contracts and benefits. And so you have a clear understanding of what the overhead is for this business, as well as what the revenue streams are. You should review all the intellectual property owned by the business. What are the trademarks, copyrights, and patents that are owned by this business? So some information that's needed for the purchase agreement. A full list of all the assets being sold. Now I'm assuming this is an asset acquisition and not a stock or membership interest acquisition. So what are the assets being sold? If there's equipment or machinery, it should include the manufacturer, the model, and serial numbers for it. And this includes if there's vehicles or trucks being sold as part of the assets, then the VIN numbers for those as well as the make and model. A full list of any assets that are not being transferred. So what are the assets that are excluded from this deal? A full list of any assets that might have any kind of lien on them or encumbrance or be leased. A full list of all equipment and real estate leases that need to be assigned. What is the purchase price? That needs to be listed in the purchase agreement as well. How will that purchase price be allocated? So your accountant should advise you on this because there are tax implications of how this allocation of the purchase price. So if you're buying a business for $100,000, how much of that is going to be allocated to goodwill and how much of that is furniture and fixtures and equipment? It's important to know that because there are tax implications. How is the purchase price being paid? Is it cash at closing? Is there a part that's being paid up front as a deposit, being paid before the closing? Is there a part of it that's being loaned from the seller that's going to be evidenced in a promissory note that needs to be clearly stated in the purchase agreement? What is the proposed closing date? What contingencies are there? Is it contingent on getting a new lease with the landlord, or if this is a franchise, getting an actual franchise agreement with the franchisor or approval by the franchisor? What other contingencies are there? Is this an as-is deal or will there be warranties? Are you buying the assets as is, or will the seller be warranting not only the assets but that he or she is compliant or it is compliant with all federal, local, state laws, and so forth. Closing documents. So here you are now, you've gotten to the point where you've done your due diligence, you have a signed asset purchase agreement or stock purchase agreement, and you're now at closing. You might sign that asset purchase or stock purchase agreement at closing, or you might sign it ahead of time. Are all of the intellectual property rights, including domain and website ownership, transferred over to you, or do you have all the paperwork to ensure that they will be transferred over to you? There's trademarks, copyrights, patents. Do you have all the paperwork so that those will be transferred over to you, or have they been transferred over? How about an assignment of the real estate lease and any equipment leases, along with the landlord's or lessor's consent to those assignments? How about an assignment of any franchise agreement or approval of the franchisor and entering into of a new franchise agreement? If there's a non-compete agreement, that's typically signed at closing as well. Bill of sale, which is the document that transfers title to the assets, should be signed at closing. And in those states that have any bulk sales laws or need to have a bulk sales affidavit, there should be a bulk sales affidavit that's signed at closing. And any other documents that are part of the deal should be signed at closing. There might be tax clearance certificate that you might need it to obtain at closing to make sure that there is a tax clearance of all the assets, so you're not buying assets that have tax liens or could have tax liens down the road. So you would get that from the state. If the purchase price is borrowed from the seller, you will have a loan, and that would be evidenced by a promissory note. And so the promissory note, you should definitely have an experienced attorney draft that or review this document carefully, is because there are often some very harsh provisions in it. The note's going to contain the following types of items: the dollar amount that's borrowed, The term of the loan, is it a 1 year or 5 year or 10-year loan? The interest that's being charged on the loan, and if there is interest, the monthly payments. Is this a fixed monthly payment? Is it just principal? Is it just interest? Is it divided equally among the term of the loan, or is it that some of the period of the loan you're paying only interest or you're paying only principal? And then there may be a balloon payment at the end. It can be any of those. What are the default provisions of the loan, and what are the remedies of the lender, meaning the seller, if there are default provision, if there is a default? What kind of notice do you get as the borrower if there is a default, so that you have an opportunity to cure that default? So that's the first document. Typically, the second document, if there's a loan, is the security agreement. And that's the document that says that what the collateral is that's collateralizing this note. And typically, that's the business assets that are being sold. So in that case, the security agreement would document that, would talk about how a default happens and what the remedies are and how those are exercised. And typically, if the assets of the business are securing the loan, then there will be a Uniform Commercial Code financing statement known as a UCC-1 filed with the state. And that puts a lien on the assets. So what are our services? We advise on the due diligence that is needed and the kinds of due diligence that you should go through. We will help with that. We'll prepare all of the documentation needed for the purchase or the sale of the business. We'll advise on the warranties and other provisions of the purchase agreement that are needed. We'll assist with the proper structure of the business. We'll form the new entity for the business, because we will recommend, if you're buying the assets, that you form a legal entity as a corporation or limited liability company for the business. We'll review all the leases and contracts and provide advice about them. And if this is a franchise business, we'll assist with evaluating the franchise. And this is just some of the services that we perform. There might be other things that would be needed as well. We're here to help you. So this is again Nancy Lanard at Lanard and Associates. My full contact information appears on this last slide. I look forward to hearing your comments about this video, as well as any questions that you might have. You can reach me at nlanard@lanardandassociates.com. Website is lanardandassociates.com, and I look forward to the opportunity to helping you with your acquisition or sale of your business. Any questions, please don't hesitate to call me at 215-392-0030, extension 101, or again, email me at nlanard@lanardandassociates.com. It's been a pleasure, and have a great day.